Good morning. It is Monday morning. We are about 30 minutes before the stock market is going to open. This is the morning after the Super Bowl, and I hope you enjoyed the game between the Seattle Seahawks and the Patriots. It was a hard fought game. Defenses really showed up on both sides, but Seattle just had too much and they took the Super Bowl win. Last Friday, we had a good day on the stock market, but it has been a couple weeks where a lot of volatility, especially around some really well-known stocks. So, what's going to happen this week? You know, we'll see. We'll definitely see what's going to happen. We'll share our comments around the VIX. We'll share our comments around what we're seeing out there, and we're going to get into some stocks. We're going to evaluate stocks from a fundamental perspective and also look at the technicals. I am joined by Daryl. How you doing this morning, Daryl?
I'm doing very well, Victor. It's good to be here. Hello, everyone.
It's great to have you. And Daryl's going to handle all the technical analysis, does an awesome job in that area. So you get two worlds, the fundamental investing methodology, along with technical analysis on the same stock. We've already got a couple requests from members of the community. We're going to be go over IREN, which has been a high flying stock, and it opened up the year just going to the moon, but it's really come down more recently. Somebody asked if we can take a look at that. That is a member of the community. Next one is ALB, and I imagine the person who requested it probably saw the stock on the stock contest list because it is the number one company that's performing. And let me take a look at that real quick. So right now it's up 60% as I speak, and it's really doing well. So somebody asked, "Hey, can we take a look at that?" We'd be happy to do so.
So is
And
it,
next,
I thought you said ALB. Is it ALM or ALB?
oh,
I
you
was
know
gonna,
what? I appreciate you correcting me. It's ALB that
okay.
somebody wanted to look at.
Okay.
All right, let's rewind, delete everything I said for the last 20 seconds. We're going to look at ALB. We're looking at Southern Copper, which is symbol SCCO. We're going to look at Next Power, which is NXT. And if you would like to see a stock, looks like Mitch is on. It's been a little while, Mitch. Good to see your name. Wants to look at SNPS.
NPS.
That's Synopsis, I believe. They're in the semiconductor space.
NPS.
S-
NPS. Nancy Papa Sierra.
okay.
Oh no, SNPS. I thought that was a dollar sign. I'm sorry.
No, it's cool. It's early. It's Monday. I'm clearing the cobwebs. So, and I believe that's Synopsis, and I'm familiar with the business.
Okay. Yep. Me too.
All right. So we already got a nice list of stocks we're going to look at. Before we jump into that, let's see what kind of situation we find ourselves in on a Monday morning. Looks like gold is going higher. It's really worked for the last couple of years. Crude oil is taking I guess a day off. It's at $63.21. The futures should open a little lower. I'm especially going to look at Amazon, Google, Meta, because those stocks did not participate on Friday. There was some high flying stocks on Friday, but as I'll show here, not everybody was allowed into the party that Wall Street had. Nvidia was the guest of honor, going up almost 8%. That's the biggest, most valuable company. So when it goes up 8%, that's like well over $300 billion of price appreciation to that market cap. Incredible. Broadcom, AMD, and the space that supports semiconductor, Lam Research, Applied Materials, ASML was up. So those were flying high. Robinhood was up, geez, like 17%. But Google was down. Meta was down, Amazon was down. I'm curious to see how these stocks trade this week. And curious is an understatement. I think the way they trade this week tells me are investors going to come in and buy these prices because these are really good businesses. I don't think anybody's going to argue that these are terrific businesses. They just are, they're in a place in the current, call it business development cycle for themselves. In the case of Amazon, they want to spend $200 billion. Google wants to spend $180 billion. Meta wants to spend $140 billion. So the market's thinking about it like, what are you guys going to do with all that money? We're going to build these awesome data centers, and we're going to build AI related businesses for Google, specifically building out Gemini, giving other developers a real good cloud where they can develop AI. So it's not like they're going to build like a beautiful corporate office or a campus or something like that has no future return on investment. No, if it works, it's going to have a future return on investment. Same thing with Meta. They want to build new experiences for the more than 3.5 billion people that log into a Meta app every month. It's a lot of people. So the distribution is a huge advantage for Meta. And Amazon wants to build, on top of being the number one cloud infrastructure business in the world, they want to continue to be that company. And cloud infrastructure is, in me understanding that business, and I also invest in real estate. I invest in REITs. Operating cloud services is a little bit like having a real estate investment trust. And let me explain. You build a data center, it's like building a really nice, residential structure. Now, if you built that structure and you built this mansion, 6,000 square feet, it's beautiful, and you're going to move into it. Well, I think it's clear that it's going to be a cost. You're going to be very comfortable. It's going to be, especially for a Super Bowl get together, right? It'd be perfect. And that's great. But let me flip that and say, what if you were going to build a 6,000 square foot structure that was actually a fourplex? And that fourplex you were going to rent. And your annual cost of capital, I'm going to keep the number super simple, is $50,000. Those are all the costs that go into that property. But your rents are $100,000. You're like, whoa, I'm going to make $50,000 free cash flow, $50,000, and I'm going to make that for a long time. When they build these data centers, especially Amazon, they don't intend on consuming most of that infrastructure. They're going to be renting it out, like the person who built the fourplex. So at the beginning, it is a pretty substantial investment, dries up a lot of that cash. But boy, in a couple of years, that investor looks real smart because they're just generating that cash. And that cash is not going to go away. These are very hardy businesses. Amazon's cloud infrastructure business is going to make money for the next 25 years. It's a necessity. We keep building more and more. So these particular businesses are gaining more value. But right now, the market's not quite sure. Sometimes the market wants its cake. It wants to eat it as well. So I'm curious to see, are investors interested in buying Amazon, Google, Meta? Will NVIDIA give up a little bit of these gains? Broadcom. And these guys rallied because Amazon, Google, Meta, Microsoft, if I do the numbers real quick, they're going to spend well over $700 billion in 2026 in data center. So a lot of those billions of dollars are going to go to NVIDIA, Broadcom, AMD. They're going to put these guys that provide the materials and machinery into the semiconductor foundry supply chain. A lot of revenues are flowing in that direction. So that is rational. This is rational. This is rational. To some extent, this is understandable. But as I explained, I want businesses that are strong, almost like a monopoly, right? Monopoly is kind of a bad word, right? They're illegal. But there's certain businesses that we know, well, they kind of are a monopoly. They're so good. They're kind of like e-commerce on Amazon. Man, they're pretty good. The second place operator is like way behind Amazon e-commerce. But, they got there through innovation, hard work, and building a market. So they deserve it. These are great businesses. And I don't want those businesses to just stand idle and say, oh, this is great. Let's just kick back and enjoy this for 10 years until somebody replaces us. No, they're like, no, we don't want anybody to replace us. We want to strengthen our moat. We want to strengthen the barriers to keep competitors out. We actually want to build a bigger castle that we want to protect. We want to build a bigger company with more profits, with more future cash flows. And we want to protect it. So that's what these businesses, in my mind, are doing. So interesting week we had in the rearview mirror. All right, we got a lot of people coming into the stream. Good to see you guys. As mentioned, Mitch is on. It's been a little while since I've seen your name, and it's great to see DJ, a regular. Monday is down. That's a software stock. And software stocks are just getting hammered. Good entry point. Geez. Let's talk about that. I'll have some comments there. And are you guys buying CRM? Zubio, I can look at CRM. You're not a member, so a $5 super chat, and we're off to the races. What's up, Shadow Guy? Good to see your name. And yeah, Monday is projecting to grow, along with a lot of software stocks, and comments to come. All right, so let's get into a couple of stocks that are out there. We're going to start with IREN, and IREN is a NeoCloud company. They have a few advantages that are interesting. So IREN operates vertically integrated data center business in Australia and Canada. And they also control some of their electrical infrastructure, I believe. And let's take a peek at their website. I believe one of their advantages is that they use hydro. So this is what they believe their difference is. The infrastructure engineered not for what AI needs now, but what AI will demand next. So they have the AI infrastructure, future-proof, and they own and operate. So their data centers up in, I'm not an expert on geography in Canada, but I believe this is Vancouver's part of which province up in Canada? I don't know. But it's up. I know Vancouver's up here. Vancouver's beautiful. They have some in Texas. Purpose-built data centers. Okay. So they're a NeoCloud. And the charts on this are going to be interesting for sure. Now, the stock for a while is just killing it from mid 25 until beginning November 25. This stock just was on a tear. It tripled. It settled down, and then it rallied, and then it settled down. So this is going to be more of an assignment for Daryl. what I'm seeing is there's maybe this stock, there's a little bit of concern. Investors are not sure if this stock's going to hold its stock price, but some investors feel like this thing can go back up to $70 per share. It could be a real winner. As we look at this business, the things that are positives and negatives, that's how I'm going to label things as we talk about this company. So they have a fiscal year that ends June 30th, but for the trailing 12 months, they're growing at 171%. Now they're a small company compared to like the likes of Meta and big businesses, $757 million. And they were tiny 6 years ago, like $2 million. So they grew. That looks really good. And let's take a look at the quarterly. That's always interesting to take a look at. The quarterly looks good. The most recent quarter compared to a year prior, it grew by 59%. So that's real good. Now, this is a data center. So data centers, it's not like Meta where, if advertisers want to advertise even more, it's almost like the ability to perform those ads is somewhat unlimited. I know that there are limits because you don't want to make the experience for users really awful. Or Uber, right? Hey, the San Francisco area, they just hosted the Super Bowl. Hey, we're going to need a bunch of new Uber riders. So they could definitely meet that demand. They could raise prices, surge pricing, and drivers are probably like, hey, the Super Bowl, I could probably make a lot of money. So I'm going to drive the week of the Super Bowl, and especially Super Bowl night. I'll make a lot of money and I'll listen to the game on the radio. So those businesses can grow pretty much with little pushback from certain variables. But in the data center business, you built the data center. It's almost like an apartment building, and maybe an apartment building has 100 units. Once all the units are rented out, you can't rent to the 101 person that's knocking on your door saying, hey, I'd like to rent a place here. Sorry, we're filled up. Data centers fill up. So that's one of the things that I would, if I was an investor of IREN, which I'm not, keep an eye on. Just understand how much of your data center is under lease, contract, and how much capacity do you have to sell in 2026, 2027? If you're at like 95% of your capacity, how are you going to keep growing at these rates? You're not. You have to build new data centers. Well, that takes time, capital, and it never goes right. So just be aware of that. Now, what is positive is the gross margin is really good for this business. 68% is a really good gross margin. They are making money. I imagine this was from some type of unusual gain, because you can't have a negative operating margin, then have a big profit margin unless you have a gain on, let's say you sold a business, or if they were mining Bitcoin before and they sold it at a big gain, they would recognize that gain. So that's how the numbers, to me, that's how I interpret the numbers. All right, what are analysts saying about this stock? Let's take a look. All right, so we're in the year that's going to end here in June 30th. They're growing at 137. And the year that's going to begin July 1st, 2026, they're supposed to keep growing at 126. Now, one of the things that I noticed was the last quarter, if you remember the quarterly for actuals, they only grew at 59%. So here we have, this is their Q4. I think we're operating in this quarter. They're supposed to grow 91. Then they're going to grow faster and really grow fast this quarter. So wow, the growth looks really, really good. These are going to be amazing numbers, and they're going to hit profitability down at the earnings per share line. So that looks pretty interesting. So they're going to keep this thing going for well over a year. And then you see this contraction here. That's my point of, hey, these are businesses that don't have endless supply of what they're selling, of what they're providing. So as the way that I would plan an investment around Iran is be aware of this point in time, or at least this expectation. It might be a good investment for the next year, but just don't stay at the party too long because the stock may really sell off. But I, like with any investment, manage the investment closely, keep an eye on it. So it looks like a really interesting business that's boomed. It's had a real strong pullback. Let me flip it over to Daryl, take a look at those charts and see and hear what he's seeing.
Okay, so I went back 5 years and found this auto support resistance line, and they broke out above that in June of last year and basically ran up 427%. That's pretty amazing. They're currently at 166% above that breakout point. I'm looking at them in the pre-market. Looks like they're down about 2.25%. Oops. And now we can, we're looking at 1 year. So the 5-day has rolled over and crossed down below the 21-day moving average. They're going to open lower today. The 50-day or the 21-day has rolled over starting on probably the second, last Monday, I think. And then the 50-day started to increase and looks like it is trying to go lower as well. And the 5-day will probably drop down below the 50-day today. I see a support line here that was established on the 16th of December, which is around $32 or so. I think that is actually going to be in play because we have the 200-day coming up there as well. Now, they haven't had a 200-day test since last June, but they have been below that 200 days. So my best guess over the next 30 days is probably they test this support line. When we look at these two prices here, we see a higher high in this month period. We saw lower RSI and lower PPI. That's called a bearish negative divergence. So that set up this downtrend here, which ended up being a 55% pullback. So these were two indicators that were telling you to beware. We do have an RSI that is currently sitting right around 40. It had stabilized at that point. I like to see an RSI that comes down and holds that 40 line. When it starts breaking below that, then there's definitely more pressure to the downside coming. And I think if they open lower and close lower today, that we're going to see that definitely drop down below the 40. The PPO gave us a sell signal last Monday. The money flow is currently in a neutral position, so it's between the green line and the red line. That's somewhat neutral. It's hard to tell whether it's, even though it's green, it's not above the 0.05 point. So we can't really say it's bullish until it's above that point. It is slightly today, but I think, as of Friday's close, I think today we're probably going to drop into the neutral zone. So let's take a look at the weekly real quick. We can see that they're right at just below the 50 line, so that's moved into bearish territory. And we've had a sell signal on this one since the 3rd of November. We were trying to get a crossover, but it's breaking down. So I think IREN is going a bit lower at the moment. But I think this will find support at around $33 or so.
Thank you, sir. We've got a lot of people on the chat trying to get back to some of the folks. It looks like Falls Grave is on. Good to see you. And we will be covering Oscar. I put it on the list. We can take a look at Oscar and see what we think is going to happen there. So, Betting, you want to look at Trade Desk, right? Is that TD? I don't remember. I don't think it's the Trade Desk.
Yeah, I thought that was TDD or TTD.
Yeah, we'll confirm later. We'll cover TD.
TD is Toronto Dominion Bank.
Oh, that's right. Yeah. Last time I looked at them, they were doing quite well. Yep. Oscar, a few comments on Oscar already. Benton, IREN is a get in and get out. Might be right. All right, let's get into it. So this is, I just updated this and I made a few changes from last time. Their cash flow is improving, and I'm basically projecting what they're going to do over the next 12 months. I'm going to grow the second string of 12 months by 75%. Ooh. But we saw that the revenue is going to contract at some point, right? So it's not going to be 75% forever. In fact, years 3 and 4, I'm going to grow cash by 10% and then terminal by 4%. I think that's a forecast that I think is realistic. It's a good, educated estimate. And over time on a stock like this, numbers really change. So it's not like Procter and Gamble trying to grow by 1 to 2%. No, we don't have that kind of business here. This is neoclouds or new types of businesses. So got to manage your updates very, very closely. Long and the short of it is what I'm expecting from the cash flows of present value is 10% more valuable than the current stock price. I'm using a higher discount rate because this isn't a riskier business. What if there's a slowdown on AI spend? They have these data centers basically empty or partially empty without revenue coming in. That would be a problem. Looking at the earnings per share is solid. I'm going with a 25, and I'm not going any higher. Why? It's not a hardy business. It's not, is IREN going to have revenues grow indefinitely? No. It's just not going to happen because we already see in the forecast that there's a contraction out there. These guys are temporarily really selling a lot of services. Good for them. So I'll give them a 25, which is, I think, right. And it's going to grow real strong. So there is a discount on earnings per share, but not enough for me to put my capital into this stock. This is too risky. I'd rather go into a risky stock with a 50% discount, 60% discount. And the story is something that I could get into. It's a story where this business is coming back, or the market doesn't yet realize how important this business is or this industry. And this one here just is not compelling to me. So IREN is really pulled back, and that's my analysis of it. Thanks for covering the charts, Daryl.
You're welcome.
Let's move on to ALB. Albemarle Corporation provides energy storage solutions worldwide. It operates through three segments: energy storage, specialties, Ketgen. The energy segment offers lithium compounds, including lithium carbonate, lithium hydroxide, and lithium chloride for use in lithium batteries used in consumer electronics, electric vehicles, power grids, solar panels, high performance greases, specialty glass used in consumer appliances and electronics, organic synthesis processes. All right. So they do a lot of interesting things. It's a specialty chemical. Materials has been a really good sector for the last 12 months. Take a look at their website just to see they can give us a better understanding of their business. So they're in the EV space, energy. Okay. Okay, so they're materials company. All right, so for the past year, this one's just been a total winner, 102%. And this chart looks pretty darn smooth for it going up 102%. Or the 5-year, look at that, amazing. You're basically breaking even. Some investors got in a little too early, a lot too early, and had a really rough ride, but the past year has just been a really good looking year. Analysts think it's gotten to its fair price, pays a small dividend. With the stock going up over 100%, it is a surprise that for the trailing 12 months, revenues are down. I would have thought revenues are really booming. Stock price is up 100%. I would expect, boy, revenue must be growing by like 30, 40, 50%. Nope. That's a surprise. I'm not going to do it on the stream, but I'd have to get my head around, well, why? Like, why are we, because that's irrational, right? Why is the stock price going 100%? Are they working on some type of new material that's going to go into something that's in really high demand? So that's kind of a yellow flag. Got to explain, have to explain, because this is not looking right. We're looking at the right stock. Yeah. Let's take a look at the margins. See if this is an attractive, valuable business. Gross margins are kind of all over the place. They used to be 42. And this is where the stock was going up and it had a lot of volatility. And I think solar was pretty hot back in 21. And margins have really contracted. It's probably because in their industry, the commodity price went down. And like commodity driven businesses, they take the price that the market's willing to pay, and then they sell it. They sell their material. It looks like the price for this material has really come down. In 24, it was quite painful because their gross margin was 1.57. Operating margins are really low. Profit margins really low. Free cash flow really low. So to this investor, I'm like, I don't want to invest in this. It's up 100%. It doesn't make a whole lot of money. But let's look at the forecast. 19 analysts cover it. That's a lot of information coming into the mix. The revenue is going to grow, but not incredibly. And it might be that the stock sold off so much that it's kind of come back because investors believe, hey, it's going to start growing again and times are going to be much better. And it's going to have that profit, Forward PE is elevated. This is a material stock. I showed you the margins. Now, what deserves a 25 PE? Growing margins, free cash flow are great, but 25 is not, hey, they do 12% gross margins. They do 1 to 2% profit margin. That's a 12. But at best is a 12. So this is really elevated in my book because this line is not getting me all that excited. This is kind of growth, but not incredible growth. It's not even like Meta. Meta's gigantic and they're growing 22%. Amazon's humongous, growing by more than 10%. So these guys are not that big. They're commodity driven. So this one here is looking like a stock that I would probably not get close to, but let me turn it over to Daryl, see what he thinks about ALB.
So they started a pretty significant downturn in November of 2022. The 200-day had been rising. It finally rolled over in June of 2023. But we had 2 points that we could have connected that would have given us this trend line, and it did hit it a third time, a fourth time, finally broke out in August of 2025. So that's a 5-year view. And I put these Fibonacci retracements over here because anytime a company's recovering, you can look at the high and the low, and each one of these Fibonacci retracement lines will serve as resistance. So when I put my cursor to highlight that 50% retracement, you can see exactly where it stopped out at that 50% retracement line. So these become pretty valuable when you're watching a company do this. It's going to have to fight to get through each one of these because they are kind of natural resistance points based on the golden ratio. So let's go into just 1 year now that we know why those things are there. They have a 200-day that's increasing, a 50-day that's increasing. The 21-day is rolled over. The 5-day is crossed. Below that, we have an RSI that was oversold for at least a couple of months and then dropped, and it held support at the 40 line. So I do like to see that. We've been on a sell signal in the daily view since about the 29th of January. I'm going to go back to that 5-year view because I saw something that was quite interesting. This had been accumulated for many years, and once the distribution started, it really hasn't stopped. So if I draw that down to there, you get the idea. That's 1, 2, 3 years of distribution. It is getting a little bit of accumulation, but it looks like it may be stalling out. The money flow is in bullish territory at the moment. So this one will be one to go and look at the weekly view as well. We also have a sell signal in the weekly view. It's coming out of overbought on the RSI, and we have a sell signal. So I think in the short term, maybe a month, it is up today, but I think the trend is probably going to be to the downside but we are above 50 on the RSI, so might be changing my mind a little bit. We're also getting a buy signal in bearish territory. So what I'm seeing today is kind of changing my mind. If I'd only looked at the Friday close, I would have thought this one was going a little bit lower. But it looks like it's reversing. It would have to hold hold this if because it could be just a head fake. We'll just have to keep an eye on it for the next day or two.
Well, I saw a lot of head fakes yesterday in the game, but let's not get head faked with our investments. The market has opened, and Nvidia just will not leave the party. It was up almost, was it 8% on Friday? It's up 1.73%. Wow. Incredible. And Microsoft's at the same party. Meta's up higher. Google just a little bit lower. Amazon continues to sell off. And Amazon on Friday, I would say at its worst point, it was down like 9%, but then it closed down less than 6%. So there were some buyers that came in and bought Amazon. I was one of them, and I will be a buyer of Amazon stock today again. It looks like the computer hardware space is selling off. Lam Research, IBM is selling off, and a couple other spots within consumer discretionary. Capital markets are booming. What's going on? Robinhood up 3.44. Robinhood is like, boy, Robinhood is like, I imagine I've never owned like a Ferrari, but once that Ferrari starts to run perfectly and you're going down the highway, man, just such a nice vehicle, but it's always in the shop. And when it's not running right, you got to take Ubers everywhere. So Robinhood is like that Ferrari. I'm a stockholder, and when it goes, boy, it goes. It runs really well at 200 miles an hour. It's not a steady stock. If you want to cruise at 35, you probably want to buy a different vehicle. All right, so that's what's happening in the stock market. Let's dive into another stock. Take a look at Synopsys. Synopsys is a company that operates in the semiconductor ecosystem. So semiconductors kind of crash courses. So we have computers, we have servers, we have devices that need all these microprocessors and semiconductors. So they say, hey, this is a design we need. Okay, great. A company like Broadcom could design it, and then they go to a foundry, and the foundry could be TSM most likely. They're the biggest one. And then they go, perfect. Okay, so when they're first designing, they say, we think this chip is going to perform at these levels and have this type of performance. And they're like, okay, well, before we invest a ton of capital, producing this thing and customers testing it and then realizing that it has a different performance level than what we think it should have, is they go to a Synopsys. They say, hey, Synopsys, can we put this chipset to the test? That's what their software and their whole platform does. So then they can validate and say, hey, this chip will do A, B, C, perform at these levels, and they have the test. So because these companies that will use that chip down the road, let's say Apple is looking at a chipset for a new iPhone. They're like, well, we don't want to make a commitment and start designing that chipset into our device unless we know that is going to perform at the right level. They look at all the documentation, they look at all the details and say, okay, that chipset's the right one. They put it into their device. So Synopsys fits into that whole ecosystem. Now you would think, boy, we got semiconductor companies going through the roof. And this one was going to the moon for a while, and it faded. And the last year has been rough because this is not a company like, for example, the memory companies like SanDisk are just exploding because there's a shortage on memory, because they are just basically selling these units for as quickly as they can for as much money as they can sell them for. Synopsys is like, hey, I'm looking for companies that are designing new semiconductors, and then I want to partner with them. I want them to become my client, and then they invest big into Synopsys up in the Silicon Valley. All right, so they've been growing nicely. I understand this growth, right? It's not NVIDIA at 70% because of what I just explained. This is a big decision. This is like ASML. I invested in ASML the right way, and I've made money, made a very good return on ASML. I'm thinking so this is what's going through my mind. Okay, what's going on? This stock is really seeing a lot of red days. Looking forward to what Daryl's going to say on these charts. This is way too difficult for me to interpret. But when I flip to the revenue, I'm like, wait a second. This is pretty darn consistent. This should be, in most cases, if they have very good margins, profit, cash flow, this should be rewarded. $7 billion entity is pretty good size entity. Cash flow has not been growing. We can look at that and see why has it not been growing. Look at these margins. 81% margins. 81%. We just looked at a material stock, and in 1 year they're at 1.2 because the commodity prices. So Synopsys is making 80 times what a material stock. So I just want to point out that there's differences industry by industry, and this industry has a lot of intellectual content, a lot of patents, their brand, right? Apple and these big companies are not going to trust just anybody. So Synopsys has earned their brand. It's earned a good reputation. Profit margin has come down. This is why the stock price has been beat up a little bit. Is, hey man, we'll buy your stock if you keep showing better profits, but if you keep coming down, we are going to sell your stock. Cash flow has been coming down as a percentage. So this is an explanation for the stock not performing all that great. Now, this is rear view mirror stuff. Good stuff. I'm liking I find what I'm seeing interesting. And I feel like I may be hitting some pay dirt, that I may be finding a good idea stock. It's press on. I want to find the next ASML. I want to do 70% rate of appreciation in a year. That's my job. It's 14 analysts. They think it's discounted. So when we look at earnings per share, so look at this growth. That's good growth. 39%. So let me back up. So I'm trying to put the pieces together, right? Kind of like we just saw their cash flows going down percentage-wise. Profits going down percentage-wise. Well, if we're moving from this year into a year where they're going to grow 39%, maybe you have to put more capital into your operations to get ready for that bump. Maybe you hire more people because, hey, we're going to have all these new clients. We're going to need to hire people who can manage those clients because we want those clients to have a successful experience with us. So this makes sense. And tying it back to the income statement, the decline in percentage-wise of profit. So all this is making sense to me. It's rational. It's like, okay, this business may be its numbers, if you don't understand them and try to put them in their proper place, could cause some investors to sell. But investors like me are like, wait a second, looking through the windshield, looking forward, I'm liking this growth, and then they're going to keep growing. So I'm liking that a lot. P ratio is coming down because profits came down. So far, this has the makings of a good stock idea. I'm going to work on my valuation. I'm going to kick it over to Daryl because he needs to do the heavy lifting on this chart. Look at this chart. Holy smokes. Good luck with that, Daryl.
Yeah. So they are in an overall downtrend. They've been downtrending. Started June 30th. It was confirmed around September. We've connected the downtrend line to those two spots. That was a pretty significant drop, 35% in one day. I don't know if that was earnings related. I suspect so. This downtrend line cuts through here, and they did get above that downtrend, but now they're trading below it. The 50-day is increasing. The 200-day looks somewhat flat. It may still be increasing. They're trading below both of those averages. The 21-day cut through the 200 and the 50 and looks to be still downtrending. Looks like they sold lower 4 days of the 5 last week. And it looks like about 3 or 4, probably 3 out of the 5 days last week. We've had a sell signal on this one since the 22nd of January. We're seeing some distribution, and money flow is currently neutral. They are getting a bit of a pop today during trading. They're up 1.47% today. It looks like the short-term downtrend is still in play, so this could be a head fake. I'd be careful if you want to enter. The RSI is moving back higher. If you want to enter, make sure you keep your stop loss because this could reverse pretty quickly. They haven't quite made it back up to the 40 RSI. They're currently sitting at 36. It just changed right in front of us, so it went down from 37 to 36.
So you're all done there, Daryl?
Yes, I am, sir.
Nice work, sir. All right, we're going to create this valuation from scratch. We're going to do it step by step. I didn't have this company valued, so we got to value it here. All right, let's start with cash flow. I'd like to get my trailing 12 months. In a perfect world, sometimes I have to use different means, and I'm going to show you an example. Because let me show you the example of this was a successful investment, okay? ASML, I saw this thing come down. And again, I find opportunities, I take them for a ride, I make money, and I'm like, how can I do that again? Right. And so as I look at ASML in the rearview mirror, I had to ignore the information that I had in front of me because it didn't represent this business well enough. So I went with the 6-year average as a cash flow expectation. ASML has been around forever. ASML is going to be around for forever in the future. They make these gigantic machines. Anybody wants to compete with them, good luck. Good luck. And I bought it at the right price. It's done really well. So let's get into the cash that our friends over at Synopsys have been kicking out. I'm going over the stock analysis website that I was just sharing with you. Now we know they're growing, so that's a good thing. It's always a good thing. Top line growth is, I would put that when I do my desirability quadrant, which I'm going to get into on this stock because I want to make that point. The biggest weight I have on the score that I have on a business based on desirability is that top line revenue growth. It tells me that their product is really in demand. Customers like it. More customers are buying it. Customers are willing to pay a higher price. It's all good. So that top line growth is super important. So if they're growing, I'm good with it. Now let's take a look at free cash flow. Their trailing 12 months is $1,349,000,000. And I'm going to grow that. The other thing I like about this company is they've been fairly consistent, right? You see their numbers, and it kind of makes sense because these guys are not selling like $1,000 product like an iPhone. They're trying to get as many people to buy $1,000. No, their solution is like, hey, you're a semiconductor business. This is going to run you 10 million a year. So you don't have a lot of customers that are like in that category. In some cases, they're probably like Nvidia is probably, I don't know, and I'm guessing like 100 million, $300 million a year customer, because this process is really important to them. All right. So the growth rate, 12% isn't a bad number, although the growth rate in the first year was looking pretty darn spectacular. So spectacular needs a different growth rate, because this is not spectacular. Once they get out of the spectacular year, then we will go back to normal. So 25, okay, we're good there. We're going to take this guy and grow the initial 12 months that we have ahead of us are going to grow much nicer because they have this big growth coming. Okay, I'm good with those numbers. Okay, now let's take a look at their balance sheet. Balance sheet's got to be good. Debt to EBITDA has to be under 3. In this case here, they've got $2,960,000,000 of cash, not debt. So I put it in the wrong row. No problem. $14,290,000,000 of debt. Okay. And my shares outstanding are likely wrong. They are. And shares outstanding, 191 million shares. Okay, so here's the cash forecast. Let me kind of take a look and see. Historically, as mentioned, they haven't grown their cash. So free cash flow. And let me show the screen that I'm looking at, because I'm kind of looking at the cash projections and saying, because that makes sense, right? So I'm focusing on the free cash flow line here. And you see how 21, 1.4 billion, 1.6, 1.5, 1.2, 1.3. It's like, all right, if you look at NVIDIA, it's like double, triple, it's just going up. You look at Meta and others, it just goes up. This was not going up. It's struggling to go up. Okay. So back to the valuation. I can't project any more optimistic method. So this one here, based on the discount available for the stock, the sell-off is rational so far. That's why we do the homework. That's why we look at the fundamentals, do evaluations. Is we want to make money. We don't want to lose money. I'll just update this PE ratio. And there's a difference between ASML and Synopsys. We can look at the two. They're next to each other, one on top of the other. PE ratio on a business that's growing like this with their margins, I'll give them a 25. Growth rate, 15. That's fine. So they're fairly priced. I'm right there with the analyst. Well, I'm sorry. The analysts think it's discounted. So I'm not with the analyst. I think this thing is priced too high. Because our friends over at ASML, they have a powerful moat. I once had these guys discounted. I bought the stock. I'm doing really well with it. Now that the stock's gone up. So Synopsys is a sell. I don't want to put my capital into Synopsys. I chose ASML well, and I'm going to stick to ASML. I will put Synopsys on the watch list. I think it's a productive exercise. Take a look at stocks like that, because sometimes high level stock looks good fundamentally, and then you dive into the fundamentals and you put them through evaluation. That's why I have evaluation. I have a process. Stick to the process, go through the steps, evaluate, compare it to somebody else in their industry. And pretty soon you see, hey, this sell-off makes sense. I don't want to buy into a business that is it's being put in a category that's really popular, semiconductor. And yep. And I think it's not worth as much as maybe the street might think, but even the stock market is selling the stock off. So I'm going to update my watch list there. That way it's all nice and clean. This updates to the Super Investor terminal, as well as the advanced member terminal. So I want to make sure I do this so that there's no missing stock. We're approaching 400 stocks that are in that listing. So that is Synopsys. It is a do not buy, do not pass go, do not collect $200 on the Monopoly board. Let's get back to the action. What's going on, stock market? So did we talk about the VIX, Daryl?
Not yet.
All right. So let's talk VIX. And then we're going to get to a super chat sponsor of Microsoft. We're going to dig deep into Microsoft. Thank you, Malt Licky, Texas. But let's talk a little VIX, and then we're going to jump into Microsoft. The VIX was at 18 last time I looked. Let me take a peek at it, see where it's at. And then we can talk a little more. So what is it, a VIX of 18.4 tell you, Daryl?
It's a measure of the annualized volatility expected over the next 30 days. So when you have a VIX of 18, they're saying over the next 30 days, the volatility of the market would be, the changes would be annualized at an 18% rate.
So it could go up 18, down 18 over the next 12 months.
Yes, but they look at a 30-day window. So this is just looking at the next 30 days.
As that's the data that's inputted to give us a projection or expectation over the next 12. Okay.
Yep.
Perfect, sir. Thanks for covering that. I wanted to just take a peek at it. And one more look at the heat map. Man, look at NVIDIA go. Crazy. Awesome. Good for them. I'm glad I own some shares. Wish I owned 5 times as many, but enough of the wishing. Let's get back into analysis of stocks. We're looking at Microsoft. The coverage of Microsoft is come to you by Malt Licky, Texas. Okay. We're going to look at the charts. And we're going to look at the fundamentals. So Microsoft's been under pressure at times, especially probably over the last 30 days. And from my observation, it's overdone. We cover Microsoft quite often. We actually covered it on a watch party 2 weeks ago and have monitored it since. It's been a rough time, right, for Microsoft. Now, this company is growing well. It's spending a lot of money in the data center. So I think the market's getting nervous around that. And 16% growth on a $300 billion business is excellent. They're putting almost $50 billion of revenue on that income statement, additional 50 billion in a year. That's awesome. That's a big business. That's a big, if you just had it on its own. Margins, excellent for a big business. Profit margins, excellent. Free cash flow, excellent. So I'm going to wear out those kind of adjectives. 47.89%. Analysts are all over Microsoft saying, hey, market's a little nuts right now on Microsoft. Revenue growth, consistent. Earnings per share growth, consistent. Getting to the teens. What's wrong with this world? These guys are growing nicely. It's got a terrific business with a moat. Its brand is super powerful. Let me kick it over to Daryl. I've got a full valuation on Microsoft that I'm going to go through once he's done.
Okay, let me take a look here. So we talked about this gap up that they had at earnings back in April of last year. And they did close that gap last week, which would have been a support level. And I can see that they have bounced off that support level and moving a little bit higher today. They're currently trading above a downward sloping 5-day moving average. The 21-day is declining. 50-day is declining and crossed below the 200-day, which is called the death cross. So, and the 50-day hasn't stopped its decline yet. So I feel comfortable here. I would probably consider for myself adding a few shares to my holding, but I have an average cost of around 238. So if I bought shares here, I would have to keep a really tight stop loss on those shares just in case these moving averages continue to go lower. I would keep a tight stop loss. So they were oversold most of last week. They are moving out of oversold, but they still have a very low RSI at 33. We've had it's really hard to say. We've been on a sell signal for them for quite some time. It's just been oscillating back and forth and then went into bearish territory. I also see a bit of distribution over the past week. We are getting a bit of accumulation back on Friday, so this will not update until the close. Yeah, so that's the 6th. That's so accumulation distribution only updates at the end of the day. RSI and the PPO, they update continuously. Money flow is still bearish at this time, so it is below the red line, which is there, which is set at 0.05. So we are just barely bearish, but we're still bearish at the moment. So this one's been a bit challenging. I think we're at a really good support level, and I'll be interested to see Victor's valuation because my valuation is right around this price, $3.99. So I think it's trading at fair value at the moment. It's at a support level. I'll probably be adding some shares this week, maybe earlier in the week than later if I see continuous price movements to the upper side. If those fall back down below that, then I don't know how much lower it could go. The tariff lows would be about 349, but I think that would be a stretch.
Excellent work, sir. Let's get into valuation, and I'm going to do a desirability review on Microsoft, looking at its moat, see how I would decide how to invest into Microsoft. So Microsoft, a very well-known business. And I would say that, man, I could probably go with a discount rate of 7. I mean, we know what we're dealing with here. And with Microsoft, it's a 25% discount. And the cash flows are excellent. Okay. Even though, think about how wealthy these companies are, like Microsoft, and you have Meta, Google. They're spending massive amounts of capital on these data centers. They still have cash flow left over. That on its own is incredible because they're building businesses for the future while having a business that even after that's like you have so much discretionary cash flow you can keep investing to build the future. Only a couple businesses exist in the world that look like that. So it looks, just really, really good. 22% discount, 31 on earnings per share, 25% discount. My app, you can get access to this if you go to rationalstocks.com, go to the member content. You can get signed up and you get a 30-day trial. You don't get charged anything until the trial period ends. You can start working with this valuation tool, by the way. It is live. And let me know what you think. So it's a nice discount. Now, it's not 75% discount. It's not 50% discount. But let me go through desirability because if a company lands in this space, I'll pay fair price if it's a strategic business. So this was really the scorecard that I did for Meta. So I'm going to update this guy. So competition, Microsoft is very strong on, the markets that it's in. And I think it does pretty darn good there. But I'm going to give it a B because they do compete against other businesses. Network power, massive. A. Balance sheet, superb. A. Revenue growth, A. Profitability, A. Free cash flow, A. So they get a 92 out of 100. Back in school, I'd be really happy with the 92% grade. So they're right in the green. Companies that a comparable company would be like Zoom. Competition, they've got plenty of competition. They're good, but they compete against Google, Microsoft, and that's a hard task. Network power, I don't know, not a lot. Balance sheet's excellent. Revenue growth, not good. It's all right. I'm gonna go with a B. Profitability, very good. Free cash flow, very good. So a 66, it's a gray. This is a growth. So there's two axes here. There's growth. So if you're a high growth, free cash flow company and you have a really strong moat, you belong in the green. But if you have one or the other, you belong in the gray. So Zoom is down here. How I would invest in Microsoft is I think the current discount's fabulous. It's a buy in my book all day long. Zoom, I have to see a nice discount, like 40 to 60%, because it's in the gray. It doesn't have the same characteristics. It's a software company like Microsoft, but it can't defend itself against Google and Microsoft, but Microsoft's got superpower. So that's where we're at with Microsoft. Great to see your name. I think you've been around before, Malt Lick, Texas. Really appreciate your sponsorship. Man, they're coming out of the woodwork today. Big super chat at $20. Jeez. Awesome. It's going to be a good week. All right. So we're going to take a look at Oust. Is that right? O-U-S-T. Check out LiDAR market, please. Your opinion on long-term industry. All right, let's do this. So Ouster provides LiDAR sensors for the automotive, industrial, robotics, smart infrastructure industries in the Americas, the Asia, Europe, Middle East, and Africa. So these LiDAR systems are probably going to be used by obviously cars. And all right, so we're going to break the industry apart a little bit. We're going to start with their website. And then we got, of course, Gemini. Gemini is going to help me get a little more educated and be able to figure out if this industry on its way up, on its way down, what's going on. Maybe. Yeah, HIMS. I wanted to do a video on HIMS and look for that. I'll do a separate video. I'm going to compare HIMS versus Lily and show how a moat does matter. Okay, so we've got Ouster here. They're getting all over. Oh, drones, of course. You know what I heard that was pretty exciting is John Deere is thinking of, they're working on it. They're going to do autonomous farming equipment. So there it is. So see the use case that they were showing there. So Deere would have, a farmer would buy, obviously they invest quite a bit on this farming equipment, these big machines that help them harvest the crops, get the fields ready. Well, they're going to put autonomous technology on it. So the farmer could basically go, okay, go plow the fields, which takes maybe 2 weeks. I don't know. I've never farmed. I don't know. It takes a couple weeks, a couple days, and it does it on its own. No human being, no person has to be behind the wheel. I think that's pretty exciting. Pretty darn exciting. Well, they're going to have to use LiDAR for that. Or the robots that Amazon uses in their warehouses, because they move like inventory from one place of the warehouse to the other. They have these racks, and those racks, there's like a little robot underneath. It looks like those vacuum cleaners, the Rambus or whatever they're called. And they pick up the rack and then they move it from one area of the warehouse to the next. So you don't need as many forklift drivers. So that stuff is already in production. So these guys are participating in that. And of course, cars that use LiDAR. So the markets are there. Okay. Now, high level, and I'd like to get your comments on this, Daryl, for the industry. What do you sense? Do you think this is an expanding market? This is a stable, not growing very much market, or a contracting market?
I think it's probably a growing market. I haven't really looked into it, but the concept is pretty genius and probably one that's going to grow for a while.
Okay. So 2 human opinions. Of course, we got to get AI into the mix here. But for all I know, Gemini was listening to everything I was saying.
Exactly.
Okay, what's going on? I was getting a delay on it. Maybe it's because it's running some video here. So let's get back to this. Okay. I think that video running in the background was confusing Gemini. All right. Yes, the use of LiDAR is expected to grow significantly over the next few years. Market forecasts consistently project robust double-digit growth, with the market expected to expand from roughly 3 billion in 2026 to 7 billion and then 15 billion by 2030. Okay. The automotive pool, got it. Industrial infrastructure, we talked about that. Robotics, drones, smart cities. Okay. All right. So Growth is expected in the marketplace. Now, is Ouster a good investment? So the whole addressable market is expanding. That's good. We're not dealing with, VHS cassettes or some other kind of contracting market. All right. So for the past year, this is up 94%, but has had a pretty good pullback. Okay. And we've got a $1.18 billion market cap business, small cap. All right. A lot of members of this channel like small caps. Strong buy, 76% discount. I'm seeing good growth on the top line of 30%. The revenue is $137 million. Let's take a peek at the quarterly. I see acceleration. I see the gas pedal being pushed down further toward the floorboard. 40.78%. That looks good. Why is the stock going down when their revenue is it's accelerating? That's a very positive thing. All right. Got to use our forensic stock investing skill set to figure that out. So they're making a physical product. So when we do that, the margins go down because you have to put direct material, labor, supply chain, all kinds of costs go in there. Whereas when you're Reddit, if you watch the video I created on Reddit, 91% gross margins because they don't have to make anything. They have their platform. It's like Visa. They don't have to make anything. People use their platform and pay them. That's why they have those super high margins. But this business makes a product. Now, these items are a little alarming, right? Operating margin they're losing a lot of money. They've been losing a lot of money for a while. Their free cash flow burn is slowing down, but it's still negative. So the forecast is going to be important to take a look at. Let's take a look at that balance sheet because a business that's burning cash better have some cash on that balance sheet. 244, very little debt. Good job. And their burn rate's 31. And it looks like they're going to go to a positive cash flow at some point. So they have plenty of cash to make it to, wherever they're going with their profitability and so forth. Okay. So the growth looks good. Profit is not expected in the next 2 years. Okay. This is a good idea. Okay. Valuation is going to be tough because you can't value zero. You can't value negative numbers. But let me kick it over to Daryl and then I'll come back with some comments.
Okay, so they are downtrending, 50 days declining, and it crossed the 200-day moving average last week. So that's a death cross. The 200-day hasn't quite rolled over yet. The 21-day is declining. I had a support level that I established back on June the 10th. It has never been tested as of yet, but I want you to see from a technical point of view, especially if you don't believe in technicals, to at least give it a shot, because look where that came and touched. So that was a value that I identified 6 months ago. It's taken 6 months, but it came down and tested it and bounced off of it. So if you try to convince me that technicals don't work, you're going to lose that bet, in my opinion.
I'm not going to try, Daryl.
Because they do work. You just have to interpret them correctly. But I had that green line there for months. Okay, and it took 6 months to finally test it, but here we are. So we do have an RSI that got oversold, and it's back to 40 at the moment. We're still on a sell signal on the TPO. We're still getting distribution. Money flow is negative. So I don't think this is probably sustainable right here, just based on everything else I'm seeing. I think we're going to see I don't know what you want to call it, a bull trap or whatever, but I think this is going to be false. I think it's going to break back down and probably spend some time around this support level.
Tell me more. Tell me more,
what?
because I was following every word you were saying, and my spidey sensors were telling me you're probably going to say that it's bouncing off that support line and going to start to work. But tell me more. Explain more there of what led you to think that it's going to struggle going forward.
50 days declining still. The 21 days still declining. It rolled over in the third week of January, and they are still declining. So we are getting a bounce today, but I don't know how sustainable it is. So the way I would handle this, if I wanted to enter it, I would have a very tight stop, because I think it can pull back and struggle here, because these longer term averages are kind of fighting against you. The 200-day looks like it could start really flattening out and roll over a little bit. So I'd be just very cautious here. I think it's going to spend more time closer to this line than getting back up to here. I think the probability is to stay right here unless they get some news event that comes out and really rocks the market. I think they're kind of hover here.
Great stuff. Great stuff as always. Let me kick it back to my screen. You were done, right, Daryl?
Yep.
Okay. So these guys are headquartered in San Francisco, and they're designing all this LiDAR. Okay, so let me give you the positives and the negatives that I see, and then I would tell you what I'm going to do with the stock is. Okay, the positives, they have an expanding market. Okay, so that's a positive. These guys are growing, they're accelerating their growth. That's a positive. Now, what are the negatives? They don't make any money. They're finding it hard to make money. They deal with a tangible product. Okay, put a period on that. Whenever I look at a business like this, like computer equipment, hardware, China is always a player. And can the Chinese develop LiDAR products that would compete against Ouster? That threat's there. I don't like that at all. So these guys are growing. Are China companies looking at this market going, hey, LiDAR is going to be big. Let's get into it. Let's compete. And if you have more competitors, the price of LiDAR is going to be lower. And will Ouster ever make big profits? I don't know. I expect, and let me test my theory, because I got Gemini here. Was probably listening to everything word I said. She's probably going to correct me along the way. And I'm sure there's going to be a couple. Yes. China's currently the leader. Oh. So this is why I would not buy Oust stock. Is China's really good at certain things. And they make all our laptops. They make all the iPhone is made in China. They make stuff. their supply chains are set up for it. Their manufacturing, people get skilled up to work in those factories and so forth. And their scientists are the real deal, man. They have really good scientists. So, the U.S. economy has a formidable opponent, not necessarily as like in a bad way. It's like being in school and you're like a good student and you're in the classroom with other bright students, right? China's a very formidable competitor, and these companies are going to compete against Ouster, and I would stay out. It's different for NVIDIA. NVIDIA makes this GPU they've got the patent. That can't be duplicated. If the Chinese stole that technology, copied that technology, and I'm not saying they do that, okay? I'm just making an example, is there would be a defense mechanism there that NVIDIA could use the legal channels and keep other companies from using their technology. LiDAR, I think you could design in a variety of ways. And right now, Ouster is small. They're not making money. So it would not be a stock that I would buy. Too many risks. And it's not clearly, I don't see a clear definition numerically of what is that payoff? How much cash flow? How much profit? What's the timeline to profitability and free cash flow? So those things are just too many question marks. And the stock, when they came out, man, it was up there. It's really sold off. So we'll see. See how it plays out. Thanks so much for sponsoring that super chat. Adam Skidmore, thank you so much. Thanks for being a regular. Really appreciate you. Consider being a member. It'd be great to have you. And let me know if you have any other questions. Let's move on. And let me make sure we've got all of his questions answered here. Yeah, so we had comments around, okay, this one's on HIMSS, mentioned I'll create a video covering HIMSS. Yeah, I think LiDAR is going to go into different products, but I think we explained, there is opportunity, but there's a lot of risks out there. And the competition from China is the biggest one that I think can really hurt the company. Not that I like Serve. They are on Serve as well. Cool. All right, good. All right, thanks again. All right, so we covered Oust. All right, I'm going to have to hurry up my game because it looks like I've got 3 stocks to go and about 15 minutes of time left. So we're going to get into Monday as a stock. Monday has been, oh my gosh. Am I reading this right, Daryl? Do I need another cup of coffee, or is this telling me that it's down 20%?
That's what I'm seeing.
It's been confirmed. Oof. I was going to open by saying the market's really beaten down Monday. But today, after this poor stock was run over by a truck, they put it in the ambulance, and somebody forgot to close the doors on the back of the ambulance, and the gurney slipped out on the freeway when the darn vehicle was going 60 miles an hour. 20% drop. They announced earnings. It's not pretty. They've been growing. Let's take a look at their earnings. It's not on stock analysis yet. No problem. And I'm not going to use Gemini. It was kind of a little slow. Maybe it's my computer, but it was kind of operating kind of slow this morning. Maybe Gemini needs an AI cup of coffee. Okay, so let's take a look at their earnings. And in general, software stocks are getting hammered. Okay. It's not like the market doesn't like this one stock and it's just hammering the stock. Nope. All stocks in software are getting sold off. Fourth quarter revenue up 25%. That looks good. Okay. So they grew 27% for the full year 2025. That looks good. That looks real good. Okay. So 2026, they're going to grow by 20%. So that is, they grew by 27%, 20%. That is a step down on growth. And it's at a time when the general consensus is AI is going to make Monday and other software stocks less valuable. Their moats are under threat. The ability for companies to create software that could potentially eliminate, avoid, minimize the use of software programs like Monday are real, to the extent that each company is going to be able to defend itself is, from company to company, it's different. If you show that their growth rate for the next year is going to step down to 20, it's almost like, showing one more chink in the armor and the market's just attacking it. Yeah. So this step down in growth, not good. That's why the stock's getting hammered. And that is that's logical. The whole thing is illogical because they're still growing, but the step down today in the projected revenue growth is almost giving the market facts that support the narrative that AI is taking away business from these software companies. Looking at these guys have plenty of money to be made. 89% gross margins. Profits are beginning to pick up because they're small. Free cash flow looks good. I have a discount on the stock. I'll take a look at that. I want to look at the forecast real quick. So this forecast needs to be stepped down. That is also the problem. This number was expected to be 20.6. It's now going to be 17 to 18. That's a big problem. That's why the market's selling this one off. It's a tough day. But man, they announced the wrong information. Well, it's the facts. They should be very honest about what's going on. But I guess the facts are exactly what the stock did not need. It needed enthusiasm. It needed evidence that, hey, we're going to be able to grow. I don't care what the stock market's saying about the projections that, hey, AI is going to be taking a lot of business away from us. But the reality is that, hey, the step down is giving the market enough for it to start selling off your stock. It's really discounted, but it doesn't matter. It's software stocks. I'm not sure what's going to cause a rally in software stocks. And I'm looking for answers on that. And I'll keep telling you guys what I'm finding. Over to Daryl. Oh my God, look at this.
Yeah, so valuations are not a timing tool. Always keep that in mind. So we're looking at 5 years worth of data because they did establish a trend channel that they traded within for 2.5 years. Then they fell out of the trend channel. That becomes a red flag. if I put my cursor where they're currently trading and look to the left, they're getting ready to test an all-time low stock price. So now we'll move to just 1 year. So I held on to this one much longer than I should have. I closed out my shares here. It was a small position, but I kept hoping they would get a recovery, and I finally just decided to cut my losses on this one, and I'm glad I did. My tracking sheet that I use, so you can see I only had 10 shares. I closed them out, so this position's closed, so I'm not going to lose any more money than that. It tells me that my total return was minus 38.7%. I usually don't let that happen, but it did in this case. This number is going to continue to update. So I can look at this number and say, Daryl, that was not a very well-established trade. And then I can come down here, oh, I feel much better, because it could have been a whole lot worse if I hadn't made the decision to sell at a loss. So there's nothing wrong with selling at a loss, because it can still do this. And based on what I'm seeing on the charts, I don't know how low this can go. We're getting ready to test an all-time low here very shortly. If I go back out to the 5 years, distribution is at its highest level in 5 years. So there are a lot more people getting rid of this one than buying it. So does not look good.
Nope, I agree with that, sir. All right, let's quick hits. We're gonna go over Oscar and then TD. Oscar is waiting for earnings to be announced tomorrow. The stock's been under pressure along with a lot of healthcare stocks, and it's really growth and the guidance for growth for 2026 that's going to move this stock. I think it's discounted substantially. It's still a growth stock. I think their story for growth makes a lot of sense to me, which is selling into small businesses and individuals, selling health insurance, which is a necessity. And I think they're going to do well over the next 5 years, but temporary or short term, we'll see what happens tomorrow. Fireworks are expected. Let's see how that goes. So that is Oscar. TD. So Toronto Dominion, last time I looked at this stock, it was doing really well. It's still doing well. Banks, it seems like quietly these banks, they're appreciating, continue to appreciate. These guys have a reasonable PE with a nice dividend rate. And I want to look at a couple of things like price to book. 1.7, that's the industry average is 1.7. So, and maybe it's gone a little higher, by the way, because last time I did price to book was about a month ago. So this is looking like they have an average price to book for big banks. So that looks okay. It's gotten price there but you could buy Citi at a lower price to book. You can buy, I think, Wells Fargo, Bank of America at a lower price to book. So keep that in mind. We look at earnings per share. Earnings per share looks all right. The growth rate is not there. They're supposed to contract this year. So I'd be careful with this one. I think there's two ways. The two roads that I see here is, first, you could say, I want to invest in a big bank. It feels safer with the big bank and so forth. Well, if I'm going down that road, I think Citibank, BofA, Wells Fargo might look better than this. Now, there's another path, which is, hey, I'd like to get into a financial services company or even a company that resembles a bank that is going to have higher growth. You got Dave out there, you got New Holdings, you got SoFi, and those could double, triple on you in the next couple of years. So this one here would not be an investment. And I think Shadow Guy mentioned Barclays. Barclays looks really good. It's been, last time we looked at it, it looked really good. So this one here, it was good. It was a good idea. But I think a lot of investors agreed and they bought up the shares. Now they priced the stock higher, so it's no longer a great idea. It's about, hey, and let's do a face-off. Compare TD against Citi. I think they're going to be close to each other. This is going to be, before I click this, it's going to be like the Seahawks versus Patriots. Boom. Look at that. Well, they're doing about the same thing there. Look at that. They're following each other. Although TD outperformed Citi by 9%. 900 basis points. All right. So let's kind of start shutting down the show here because I got to get going. Yeah, I like banking. I like both, but I don't like kind of being stuck in the middle. If I have, like, I own a little bit of Dave, a tiny position, and I own Citi, and I own some other financial services stocks. And so I either want growth definitively, or I want a big bank. And then looks like ITUB has been a winner. Good to see you, Bo. No, it's Ben. Sorry, Ben. And, I'm glad you're making that comment, which is I own some stocks that are priced above their intrinsic value, and I'm not going to sell them because I have made mistakes in the past where I sold a stock that was priced too high. I made some money, like Broadcom. I bought it at the right time. I made money. I sold it at the wrong time because temporarily it was showing that it just was priced way too high. And it ended up growing into that valuation and then exceeding that growth. So I agree with that. And investing is something we build skills around to try to make the next one a success. But even the great Warren Buffett loses money on an investment, or, fill in the box, Chase Coleman, Pat Dorsey. And I will buy some stocks where I'll make the wrong decision. I'm sure of that. But as long as I'm 70% of the time or higher, making the right decisions, I'm going to be just fine. And that's a good point there. Yeah. Software stocks are just getting smashed. See if the smashing continues. The smashing continues for Intuit, ADP. CRM is pulling off a little rally. Microsoft's a software stock, by the way. They're kind of a diversified technology business, but big part of their revenue is software. All right, Google's just Amazon's mounting a comeback. All right, Daryl. So what's going on with your channel this week?
Okay, let me open my screen. I did put out what I've been doing weekly is reviewing some interesting charts from holdings in my portfolios and how I'm using charts to make decisions on whether I'm adding, selling, or trimming, or what have you. And then we've had a whole bunch of earnings. So these are positions in my portfolio with earnings. I'm still tracking how they perform 1 week out and then 2 weeks out. So I like to keep track of what is the reaction given the beat. So we're beating by 80% the earnings, but we're only getting a 33% positive reaction. So basically, companies are reporting good numbers, but the market is not rewarding them very well. And then this week, I have two REITs that are reporting. Lyft is reporting. There's a third REIT, Q2. That's the only software. Excuse me, I didn't mean to do that. That's the only software holding that I have any longer. ETR, the energy company, which is trading pretty much at all-time highs right now, and CART hasn't performed very well, but I'll at least put out shorts on these on YouTube. That's basically a 1-minute summary of what the revenue estimate is, the earnings estimate is, whether it's in an uptrend or a downtrend, whether it has positive or negative relative strength. And I'll also provide the implied move for all of these. So those videos will be out here in the next couple of days.
Thank you, sir. Great
Thank
job
you.
today. Appreciate it. And I wanted to talk more about my website. I've been working on it extensively. I have now it live. You can reach it if you go to Rational Stocks. This is the kind of landing website. Everything you see here is kind of free to explore. But once you get to this guy here, member, content, and tools, you'll get to this landing page. It has the first page is all free content you probably recognize, but I'm really defining my overall strategy, framework, and all the different things that I think are key to being a successful long-term investor. And once you get behind the member login and you get into the paid portion, and if you sign up, you get a 30-day trial. So it's not, you wouldn't be out of pocket for the first 30 days. There's a $10 plan and a $25 plan. You get to things like the valuation application that I've built, and I'm continuing to make sure it's accurate. But here I was going to pop in AppLovin, which is a stock that Shadow Guy commented has been really rising. And you can value on cash flow. Cash flow I expect out of AppLovin is 25% weighted average cost of capital. They have lots of cash on the balance sheet, and then their terminal growth is going to be 4%. So you just click your analyze button, and it'll give you a sense of where the stock is priced. It gives you all the details like the present value, the cash flows, and so forth. You can also do on earnings per share, and earnings per share is $14.03. The growth rate on those is expected to be 20%. And then the P ratio in 4 years for AppLovin. And I think it's a really high margin business. So 25. Discount rate is 0.075. So when you analyze, oops, looks like I've got an error there. So I'll have to fix that. But take a look at the website. Let me know what you think. And there's other things on there, like the company Moat, all the analysis I've been doing there. And this is really important. When I do the video on HIMSS, I'm going to compare HIMSS versus Eli Lilly. And it really kind of is going to mirror this comparison. There's one with a strong moat, one with very little moat. And the expectations really should be different. We should be very careful with companies without a moat because as HIMSS is experiencing, revenues can quickly go away when you can't defend your market. So take a look when you can, and I will make a note that I got to go look at the earnings per share valuation and see what's going on there. All right, one last look at the market, and looks like some stocks are headed higher, some not so much. Looks like the market's pretty flat on the, whoa, wait a second. No, we're going green. We're going green, folks. S&P's higher. NASDAQ's higher. That looks really good. I can go for a green day on a Monday. And a nice chicken salad as well. All right. So that is it, folks. Great stream. Thanks so much. Appreciate everybody attending. We had a big audience today. And looks like a couple of stocks have come in late. Sorry, I can't cover them. I got to go. But everybody, we'll stream again. I'll provide the details there. I'm not sure I can stream on Wednesday this week, but for sure Friday is a good day. And I'll coordinate with Daryl so we could have this particular stream on Friday. And we'll go from there. Everybody have a good day. Good luck with your investments this week.
Take care, everyone.